What is up, Denver? Chris Lopez here, and we're going to talk about a very important topic, which is lending. We love finding deals, buying deals, investing in deals, but the sister to deals is financing, it's lending. And for investors out there, you guys know the importance of lending. We also have a lot of new investors that are getting in the game and don't understand the importance of lending or have a great lending relationship. So I have a great lender in the studio today, Troy Howell. We're going to talk all sorts of tips on how to build a great long-term relation with a lender and make sure you're doing the fundamental things for your credit to go out there and get the best loan you can. Fun sneak peek. Troy's got a fun story where someone spent $30 on a credit card and essentially saved about 5% down on a down payment and about a half a point on their interest rate. So
quarter point.
Lots of fun stuff. Quarter point?
Quarter point, but quarter point adds up.
Okay, there we go. Quarter point. So
yeah.
Correct that. So 5% down payment, quarter point. Well, thank you, Troy.
Yeah.
And this is why you're the lender. You get the numbers right.
Yeah, we try.
All right. So Troy Howell, you are a lender with Nova Home Loans. We've been working together for many years. Yes. Tell us about yourself.
Yeah, just been in the lending business. This year's 30 years now. Crazy.
Happy anniversary.
Yeah, so fun stuff. Been with Nova now 12 years. And yeah, just love the business. Love working with clients. Love the numbers. Love figuring out the puzzle of each person's unique circumstance and getting that to work within the parameters of the loan products that are available. Mainstream stuff, primarily that works, but also the fringe stuff when needed.
Awesome. And, one of the things that I really like, because I think we've done 50, 60, 70 deals together at this point, or quite a bit, maybe more.
Probably more than that.
Okay, more. We've done a last couple of years, and anytime we refer out to people, that always reflects back to us. I've always had great things back when we've sent people your way.
Good to hear.
But what I like about you the most is, hey, you have great rates. You get the deal done. But what I like about you most is you are very consultative focused, like we are here at Vision Advisors. We like to sit down. Hey, what is your goals, Mr. and Mrs. Investor? Where do you want to go? Let's talk about it, and then go out there and play the game to make a strategy fit your situation. So I like 100%. That you do that, and you spend a lot of time when people connect with you. You spend a lot of time understanding and building that relationship. So thank you. As you guys talk to Troy, keep that in mind. I think that is a superpower you have.
Appreciate that. Yep.
All right. So Troy, let's just get into the details of lending on here. You talk about 3 key ingredients that people need to focus on. What are they?
Credit, income, and assets.
Credit, income, and assets.
Yep. And just making sure that those are in position and well structured to optimize your lending capability. It tells us what you're capable of doing, how much of a price point you can do for a house purchase for a lending purpose. So understanding the nuances and working within all those 3 major areas of the loan.
So can you kind of break down and give us an example on each one on how you've been able to, optimize it for someone's loan or as they grow their portfolio?
Yeah, absolutely. So from a credit standpoint, sometimes it's just a minor tweak. We have a whole credit services department at Nova Home Loans that we can do a quick evaluation to be as efficient as possible to optimize the result, right? So you don't want to throw a bunch of money at credit cards. Hey, I need to pay this stuff off in order to get a loan. You don't. It's not always intuitive. So having somebody analyze that in depth and being as efficient as possible can make a huge difference. As your opening example kind of talked about, $30 on a card.
Yeah.
And all of a sudden you're changing the rate by a quarter, and your down payment requirement by 5% is a huge move for $30.
Yeah, and that was one of your clients who did, right? Tell the story on that, because that was just
So he
very
comes
fascinating.
He wasn't really a house hacker, but he was buying his first house. He came into some inheritance and wanted to buy a place, which was great. Get out of the rent situation that he was in and have something of value. And so he was planning on putting a chunk of money down. He wanted to at least put no more than 20% down. And we have to rely upon the automated engines for part of the underwriting process, and it'll tell us risk levels. It's one of the tools the underwriter uses. It's not the begin all end all, but it's one of the tools. It just would not, regardless of how you situated it, because of his credit situation, would not allow us to do anything more or less, in his case, than 25% down. So by doing some legwork on it and discovering that the credit score being slightly higher would do the trick, then we came up with a strategy of doing the $30 on the credit card, rescoring his credit, rerunning that new report through the system, and voila, were at 20% down, and it improved the interest rate for him by 0.25%.
So when you say this credit servicing department, like, can you, first off, do you pull my credit to do that?
At least a soft check.
Okay.
So we don't even have to do a hard pull to evaluate the credit and get some sort of take on where things are at and where they need to go or what can be done to improve it.
Great. So you do a soft check on there, and then what type of analysis do you do? Like, what, I mean, just like I get you do the analysis, but like it just kind of plays a game how to optimize your credit score.
Well,
am I understanding that correctly?
Yeah. So I have a whole department. Me is my lead gal, and she's been doing it for 25 plus years. So she's a credit expert. So she knows where the hot spots are, but there's a software system that assists her with it. So she's not just willy-nilly and trying something. So she plugs it in and knows how to optimize it. Sometimes it's aging the credit out a little bit. Most places where we attack the credit is with credit cards. So sometimes it's people that don't even have a credit score or a low credit score. It's like you need to get a credit card. For those that have a credit card, it's optimizing the limit to the balance ratio.
Okay.
And so she'll run a simulator on it. And so the results are highly probable. It's not guaranteed. You don't want to pay down this credit card and rack up a tab on the other one. But if you follow the prescription, so to speak, then you can put yourself in a really good position of successfully paying $500 down on that credit card and bumping your score by 20 points and putting yourself in a lot better position for the cost of the loan, the mortgage insurance, and all that kind of stuff.
Okay. And so in terms of like the process, hey, someone, calls in, starts with you, is that credit servicing, is that just part of like your approval process, kind of like your standard onboarding process? Where does that fit into your process?
Yeah. So it fits early on if we discover that we're a little bit below the optimal credit score. So 760 on a traditional Fannie Mae Freddie Mac loan is a threshold where pricing will change, especially with the mortgage insurance. Jumbo financing, different beast. There's different pricing for an 800 plus credit score in some of those programs. But with our traditional Fannie Mae Freddie Mac having over a 760, so somebody might come in with a 748, 759, and it's like, let's get to a 760 so we can get you in that next better tiered price mortgage insurance. Because if you're doing a house hack with 5% down, you're going to have some sort of mortgage insurance, whether you're buying it out in a lump up front or you're doing the monthly or a combination thereof. It puts us at it just is a waste of efficiency for that opportunity to save yourself 25, 30, 40 bucks a month on your payment by doing a quick little tweak. Like an engineer I was telling you about that literally only had a credit card to his name on his credit report. And he paid it off every month. He'd rack up $2,000, $3,000, pay the thing in full. Literally nothing else on his credit report. By showing that as paid, it changed the credit score enough to where his pricing for his loan changed by $3,000. Same interest rate, cost $3,000 less by us just showing that the credit card was paid off and the score difference that it made.
Wow.
So, and it's like, oh yeah, I'll pay it. He's just paying it a week or two earlier than what he traditionally would have, but it made a difference of $2,000, $3,000. So to me, I feel better knowing that we've optimized the circumstance and the situation. Clients come in with, the hand they're dealt, right? The circumstances is what it is, but getting involved early on in evaluating their current circumstance and saying, hey, you can do some things here with the credit. Maybe there's a little tweak you need to do with the income liability piece to get your ratios a little bit better in place. And then, of course, just making sure we've got everything investigated for the assets and the sources of the assets needed.
That's great. And you had told me earlier, one of your a very simple strategy is that a lot of people just should call their credit card companies to raise their limits.
Yeah.
Can you explain that again to the audience, and what is the benefit?
Yeah. So huge benefit with just having the best limit to balance ratio. And they take everything in aggregate. So if you have 3 credit cards and they're all $10,000 limit each, that's $30,000 overall. You may not have balances on the other 2 credit cards, but you have $5,000 on the one credit card. You're thinking, oh, geez, I'm at 50% limit to balance ratio. Well, no, it's not really that, because they look at the 30,000 to the $5,000. Right. And so the quick tip, and something that everybody can do, and I've done myself, is you just have them bump up the credit card limit. And therefore, in that situation, you may not have to go and pay that $5,000 down that you may not want to. Maybe you want to keep that money in the bank towards your house hack, towards other expenses you're looking at using, but you can achieve the same goal as paying it down to $3,000 by raising the limit by $5, $10, $15,000.
Yeah.
And all they can do is say no. It's not going to hurt you.
So there's no other like adverse impacts of them saying, nope, we're not going to do it. There's no
Nope.
adverse.
Nope. Not
Great.
that I've seen. Not that I'm aware of.
Okay.
Yeah, I've got like a credit card with a $50,000 limit. And it has 0 on the balance, but I let it sit there. And the older the credit card is also helpful. So don't close old unused credit cards because that can adverse. And again, that's where Mia comes back in with our credit services department because people will think intuitively, it's like, hey, I need to close that card. I need to shut that down. I need to pay that off. And it's like, you're not being efficient. And we want to be as efficient as possible and kind of understanding those nuances within the credit world and what it takes to optimize it is extremely helpful.
I like how you focus on being efficient because I don't hear many people use that word when it comes to like lending and finances.
Yeah.
But it is a great word to use for all the reasons you described. So I like that word a lot because it really is, as I've gotten, more experience in investing and entrepreneurship, all that, it's just the more I view things as a game or, hey, every aspect of investing or business or like lending, there's just a game. Great. What do I need to do to pull this lever 100%. Here and optimize it? I love your attitude about how to be efficient when going out there to play and win at the lending game.
Yeah. It just puts you in a better position to win when the opportunity presents itself.
So, we are recording this just at the very beginning of Q4 in 2023. And this, so rates are very high right now. Rates might go a little bit more, go a little bit lower. And, but for the foreseeable future, we're in some choppy times. What kind of general advice would you give someone looking at the rates now? Like, what are some strategies they should be thinking of, or how should they be viewing this to optimize what they can do in the current environment?
Again, tying back to the efficiency thing, there's a balance between being super aggressive with buying down the interest rate in this elevated rate environment versus just taking on a higher rate. So do you buy it down aggressively with some thinking in the general consensus is we're going to see some better rates. We don't know when, we don't know how much, but sometime in 2024, there's some anticipation of some better rates. So you don't want to load in a bunch of money to buy down an interest rate that you have the potential of refinancing, in 6, 12, 18 months down the road. So it's striking up that balance, but at least understanding that. So you go into it eyes wide open. And again, tying back to the efficiency piece that you're not throwing a lot of money into the deal. Even if you're getting a seller credit towards your closing cost, dumping it all into buying down the interest rate may not be the best option. So it's sizing that up and just making sure you're making the best short-term and long-term decision with the property. So we're optimizing that property. I don't want people going in thinking that they're going to refinance because you may not be able to. So you got to make sure the numbers are working at the current interest rate at what we close. So you're not in a pickle down the road.
And I guess with the same thing, because, two very common strategies for house hackers is to go in there and buy the interest rate down or prepay mortgage insurance.
Right.
Now, for me as an investor, as I've consulted with people, I'm like, hey, I'm a lot less favor of prepaying mortgage insurance and rate buy downs. But do you have that same advice for mortgage insurance as well? Because once you refi, it resets that clock as well, right?
Yeah, 100%. So if you bought it down, you paid a lump of money up front to buy out the mortgage insurance. When we go back to do the refinance, everything's going to be based on that appraised value. So hopefully the values come up enough and the appraisal comes in strong enough and you've paid down the loan enough to get you to a position where you don't have to deal with mortgage insurance. But if you're not at that 80% loan to value, you're going to have some exposure to having to deal with mortgage insurance again. So now you have to either buy it out again or you're going to deal with a monthly amount to work with. So, and there's some good evaluation that we've done with clients on that very thing, buyout versus monthly. And then what's that crossover point? In 2 years, can we demonstrate on-time payments and get it removed? I've had some very good success post-closing, just working with past clients. Hey, let's see what we can do to get rid of the mortgage insurance for you. Your rate's great. Doesn't make any sense to refinance. You went with a monthly. Let's now try to get rid of it. So, and we've done that. And all of a sudden you're saving $150, $160 a month because you've done
that helps with cash flow quite a bit.
Extremely. And you didn't have to refinance because they've got a stellar rate going.
So are you seeing fewer people like prepay and buy things down now in the current interest rate environment with people kind of betting on, or, betting's the right word, hey, rates will drop in a year or two? Yeah,
it's been a kind of a combination of things. I've seen some people get aggressive still with buying it down regardless, right?
Yeah.
Of kind of pointing the different pros and cons to that. But like I just had a gal purchase a brand new construction and we did a 2-1 buy down. So that's kind of a rage right now.
What is a 2-1 buy down?
So a 2-1 buy down is where you get a temporarily, artificially bought down payment for the first and second year. And a seller can kick in and pay that. This particular transaction had negotiated $20,000 towards closing costs. So $15,000 of that was utilized towards buying down the interest rate. And then the remainder, $5,000 and change or whatever that was used towards just general closing cost. So her thinking, her position with that is, I want a reasonable payment. I want to make sure it's manageable for me. And then my expectation, her expectation and plan is that within the next year or so, I'll be able to refinance before it gets to the third year where it's at the highest point that it'll go.
So to recap this, because this is it's a program that's out there, but a lot of people aren't familiar with it.
Mm-hmm.
So someone comes on to just say interest rates are 7%, and that's not a real quote. That's just for example's sake, everyone.
Yes.
So 7%. They then a lot of times will take a seller credit.
Mm-hmm.
So that's basically cash at the closing table. The seller gives and goes straight to the lender. And then year one, they're buying it down 2 points. So the first year, they're at 5%. And then the second year, they're at 6%. And then the third year, they're at 7%.
They're at 7%. Exactly.
And something I learned after a few months of first learning about this, I was like, hey, I like that program. But hey, if interest rates drop, you're going to refi and lose it. But correct me if I'm wrong, but that money is actually escrowed. So if you do refi earlier, you actually don't lose out the remainder. So explain that better than I did.
Yeah, exactly. So you nailed it. Basically, that money's set off into this escrow account, a little savings account to subsidize the payments, pay them down. And then, so say after year one, you pay off the loan. You're refinancing, you're paying off that loan. So year two, money didn't get utilized that's in that account sitting there ready to help pay those payments down. So that gets credited. So it's not lost money towards the principal of the loan on the payoff. So they just literally give a credit towards the payoff, and
that's where it goes?
Is reduced.
So it just goes to the principal.
So they don't hand you a check. They just do a reduction on the principal balance.
Oh, great.
So you get the benefit of a lower payoff.
Awesome. Yeah. So if you're not familiar with the 2-1 buy down, make sure you understand it. And obviously talk to Troy about it. He'll walk you through all the details over there. Great. Anything else in terms of just kind of like strategy or things you're seeing with where we're on the market right now?
Yeah, I think it's just making sure being as efficient as possible. Again, you pointed out the word, but it's a word I commonly use. Just making sure you're not taking on expenses, just keeping that cash flow free as possible is important. So not taking on any crazy additional debt. I know.
So wait, once I go under contract on a property, I shouldn't go get a new car payment?
A highly advised.
If you want to give a lender
cardiac arrest,
great. I was gonna say gray hair. Yeah, a cardiac arrest even better.
Heart palpitations, whatever.
Go get a car loan or a boat loan.
I had a guy do it years ago. Was buying brand new construction VA deal, and the real estate agent called me up and said, "Did he tell you?" And it's like, "Tell me what about the car? What car are you talking about?" He bought a $90,000 Audi with a $900 payment.
Ouch.
Luckily, he's still qualified, but it could have grenaded the deal on the spot. But he's still qualified for the deal. But yeah, so
we're joking about this here. Please don't know. It's a common mistake people make, and it really sucks for the client.
Yeah, because all of a sudden you put the cart before the horse. You want a house to put the car in, not the car to put wherever.
Exactly. Yeah. Fill the garage after you buy the house.
A house is more important than
awesome. And one thing I want to highlight here, just as especially house hackers are getting plugged in, they're building their portfolio. A lot of people, I think, talk to a lender too late. I always think hey, people a lot of times talk to us first. Hey, I want to do this. I'm about awesome. We can talk about this. You're 6 months out. The next phone call you should make should be to Troy or a lender to go out there and say, hey, I'm doing this, and start that relationship. Because if there are any issues or optimizations, the sooner you are ahead of it, the better. Yep. But don't be afraid about talking to the lender early on. The sooner you do, the better off you are.
You've got to start somewhere, right? So you might as well know where you stand. And sometimes I've had clients I've worked with for years, several years. I had a client that had just filed a bankruptcy, and kind of a unique situation, but his mom had essentially bought the house for him. And so his mom wanted to be taken out. She wanted to be off the deal because she needed to go do some other things. So we did some offbeat financing that would accommodate a situation where we had a bankruptcy less than 6 months ago. So there are loan programs for that. We did that, and then subsequently, as we got to a better place, we refinanced into an FHA, which allows for 2 years out from a BK discharge. And then eventually we took that and got him into an even better place a few years after that with a regular good conventional loan with the good rates we saw in 2020, 2021, which is awesome. So, I mean, multi-year process, but I think to your point, Chris, is getting started early, checking things out, kind of knowing where you're at. And I've told a lot of clients over the years, you go to the doctor once a year for a physical, at least you should, right? To check things out. I feel fine. Everything seems to be good, but I don't know what I don't know. So talking to a lender, kind of getting that checkup, especially if you're entertaining doing something. So if there's some optimization that needs to be done with the credit, with the income, with the debt load, or with the assets, then you can start working towards that. And I don't care if somebody's 6 months down the road, 12 months down the road, 18 months down the road, you need to start somewhere. And you can do it a pre-approval now. And to me, that pre-approval, technically, some of the documents are going to age out. If we did pay stubs, bank statements, all that stuff, they're going to age out because they only have a certain shelf life for underwriting purposes. But if everything's status quo, really that pre-approval is still good into the future. If their income's the same, you haven't done anything crazy with your credit, and your assets have been building, 6 months down the road, yeah, you're still pre-approved. Yeah, we need to freshen up your pay stubs, maybe grab a new W-2 and a bank statement, but you're on your way. So just doing that initial consultation from a lending perspective, it doesn't cost you anything. It's just my time, your time, a little bit of investment. It makes it more efficient when the time does come around. So a lot of clients, hey, I may not be doing something until spring of 2024. Well, let's get you in and check things out now. Make sure everything's cool. Do the checkup. You're on track. Everything's perfect. Keep doing what you're doing. And then we'll be ready to go. And then you're not starting from scratch with an application and stuff. It's just, hey, just a few freshening up things and we're ready to put an offer in. It also helps you move quicker and more efficiently with your contract so that you can do tighter timelines. So if you need to do from contract to close within a few weeks, it gives you that opportunity because you're already that much more prepared. You're not starting from the ground level. So there's a lot of pluses to doing it. And I can't think of a lot of good arguments for not.
No, I agree. So talk to Troy sooner rather than later, everyone.
Yep.
All right. So something else I want to talk about here, especially for new investors, they don't have the appreciation yet for understanding how important and what a big role the lender plays in the getting a property under contract and the closing table. A lot of people, especially, come out and say, hey, I'm gonna find the lender with the best rates and the lowest fees. And I get that mindset because we all want to go out there and save every dollar we can. But I think the better question to ask is how can I go out there and find a lender with the best value? Because I've seen quite a few deals get blown up. Gone to online banker or online mortgage website. And hey, it's an eighth of a point lower than like you or another local lender. But they can't get the property closed. And then 4 months later, okay, you're worried about $12 a month in the savings, but you actually could never get the property closed. So can you talk about like the value that you and Nova Home Loans brings and just help people like understand that's not all just about the, what's written on the rates and fees?
Absolutely. So some of the stuff we've already touched on, but it's evaluating the situation of the client, of the borrower, looking at the credit, income, and assets, making sure that's, and providing guidance and expertise on that. A lot of times you're not going to get that from the big box people, the big box banks, the Rockets, mortgages of the world, the Quicken Loans of the world. A lot of those guys are just intake type persons, and they're just going to kind of feed you, here's what we've got. When there's a lot more than meets the eye. It's not just a 30-year fix. There's ways to go about doing that. So value comes in with expertise in packaging, optimization, like we've talked about the credit and all those kind of things. But that support that I can give to the real estate agent on that real estate transaction. So what you're heading towards, being able to make that call on an evening, weekday or weekend to the listing agent on an offer that's just been submitted, and we're competing with 3 or 4 other offers and getting our offer accepted over those other offers. You spend a fair amount of time looking for identifying a property, creating a contract, putting that offer in on that, doing your analysis on the property, right, from a house hack standpoint, to make sure that that thing's going to meet the requirements, that the numbers are going to crunch out good. So we want to do everything we can, and I'm part of that process to get that offer accepted. So between a strong pre-approval letter that is given with the offer to the listing agent representing the seller, to that phone call to the listing agent to reassure them that we've done our due diligence, that we've looked at the income, looked at the credit, looked at the assets, and we're just plugging in a property. And as long as the property checks out appraisal-wise, inspection, and the dates work, we have a high probability of successfully closing the loan on time as scheduled.
Great. So I asked you the main questions I wanted to, but I know, you got 30 years in the industry. So, every year always brings a couple of unique stories. Any just stories that you want to share or tips you want to highlight?
I think we've kind of hit on a few of those just because those always kind of jump out at me.
Yeah.
Like $30 at Best Buy to change things dramatically. And it just sounds so counterintuitive because he literally had no credit card usage and he didn't even have the credit cards. And it's like, dude, you go to Best Buy, they'll look you up at the register for your headphone purchase and they'll charge it to your account and then give me a copy of the slip to show that you have the balance. And then we ran with it from there. So it seems so random, but it worked and it worked to a charm. So it's those type of things. And the other guy just working him through from a bankruptcy into a traditional loan. I've had people do CHAFA, minimum down, payment programs, and eventually go out and buy a house with a fair amount of more money. I mean, it's just a huge wealth builder. So it's exciting and fun to work with clients, first-time home buyers, house hackers, or whatever, to buy a piece of real estate because you're going to have to pay to live somewhere. So you might as well be putting money in a place where you're going to see it again and it's going to build some wealth for you.
So well said. All right, Troy, this has been a great podcast. Thank you. And I highly recommend that everyone out there get in touch with Troy. You can see he likes to sit down, do the strategy, do a consultation with you. He's on a lot of our webinars, podcasts. He's at pretty much all of our house hack meetups, some other local events we do. So you'll be seeing his face and voice around town more. But I definitely recommend people reach out and set up a call with Troy.
Appreciate it. Yep,
and what is the best way for people to get a hold of you?
Call me, text me, or email me.
All right.
So all the basics, whatever. I don't respond well to smoke signals, but
no, we can try that too. No, so we'll put all those show notes, all your contact in the show notes. Troy, thank you so much, man.
Thank you, Chris. Appreciate it.